Small caps and mid caps have taken a beating. Sensex has fallen over 3,000 points in just 8 days. So should you pull out of your SIPs? Well, Motilal Oswal says no. What if I told you that you could reduce risk and actually maximize your returns by sticking with your SIP even in market crashes for, let's say, 7 years? Sounds interesting, right? Let's dive into this Motilal Oswal's report that shows exactly why the strategy works. Motilal Oswal's research analyzed SIP returns over 5, 7 and 10-year periods across multiple market indices. Nifty 100, Nifty Mid Cap 150, Nifty Small Cap 250 and Nifty 500 Multi Cap 50:25:25. They looked at significant market events like the 2008 financial crisis, the 2013 crash and the COVID-19 pandemic to see how investments performed during these turbulent times. They found that investors who stayed invested despite these crises saw positive returns. Let's first look at 7-year performance across these indices. Nifty 100. Worst annual return was 0.8%, average return was 11.3% and the best return was 18.1%. The probability of loss was just 0.6%. Nifty Mid Cap 150. The worst return was 0.4%, average return was 15.3% and the best return was 27.3%. There was 0% chance of a loss over 7 years. Nifty Small Cap 250. The worst return was minus 7.3%, but the average return was 12.7%. The probability of loss was 5.8%. Nifty 500 Multi-Cap 50:25:25. The worst return was minus 2.0%, average return was 12.8% and the best return was 22.9%. Again, the probability of loss was just 0.6%. Now let's stretch that horizon to 10 years. Nifty 100. Worst return was 2.8%, average return was 11.5% and the best return was 15.7%. The probability of loss was 0. Nifty Mid Cap 150. Worst return was 4.6%, average return was 15.9% and the best return was 22.5%. Again, no losses here. Nifty Small Cap 250. Worst return was minus 1.8%, average return was 13.3% and the best return was 21.3%. The chance of loss was only 0.8%. Nifty 500 Multi-Cap 50:25:25. Worst return was 2.2%, average return was 13.2% and the best return was 18.9%. The probability of loss was 0%. Now here's something really interesting. After the worst year in a 7-year period, what happens the next year? Let's take a look. For Nifty 100, the worst year in the 7-year term gave 0.8% returns. Meanwhile, if you stayed invested through this period without continuing the SIP, investors earned 15.1% returns the following year. If we come to Nifty Mid Cap 150, the worst year saw annual return of 0.4%, but the next year gave 20.4% returns. Likewise, if we look at Nifty Small Cap 250, the worst return was minus 7.3% and staying invested despite that gave 14.8% returns next year. Lastly, Nifty 500 Multi-Cap 50:25:25 saw the worst return at minus 2.0%, but the next year gave 16.5% returns. The same pattern can be observed if your horizon is 10 years. Take a look. So what does this all mean? The longer you stay invested, especially for 7 to 10 years, the more likely you are to see positive returns, even during the market crashes. In fact, over the 7-year period, mid-caps showed 0 probability of loss and even small caps had just a 5.8% chance of loss. The key is to avoid the temptation of pulling out when markets dip. So are you going to be invested for the long term despite the current market volatility? Let us know in the comment section below and stay tuned to NDTV Profit.